Welcome to a comprehensive comparison of three popular ETFs that track the S&P 500 index, IVV, VOO, and SPY. Let's kick things off with a brief introduction to ETFs. Standing for exchange-traded funds, these investment vehicles allow investors to gain exposure to a broad range of assets, such as large-cap U.S. stocks, without having to individually buy each one. Now, meet IVV, VOO, and SPY. The first IVV is managed by BlackRock and aims to mirror the performance of the S&P 500 index, while VOO, offered by Vanguard, seeks to achieve the same goal. Last, but certainly not least, is SPY, one of the oldest and most widely traded ETFs, also designed to mimic the performance of the S&P 500 index. By investing in these ETFs, investors can conveniently and cost-effectively tap into the performance of the overall U.S. stock market. Now let's dive into the performance of these three ETFs. iShares Core S&P 500 ETF, SPDR S&P 500 ETF Trust, and Vanguard S&P 500 ETF all started with an initial balance of $10,000 and ended with final balances hovering around $51,000, showing similar returns over the specified period. Their compound annual growth rates, or CAGRs, are also strikingly alike, ranging from 13.27% to 13.32%. In addition, the standard deviations of returns for these ETFs are nearly identical, suggesting comparable levels of volatility. The best and worst years, as well as the maximum drawdown, are consistent across the board. Moreover, the Sharpe ratio and Sortino ratio, key indicators of risk-adjusted returns, are the same for each ETF, pointing to similar risk-return profiles. Lastly, the market correlation for all three ETFs cites at a solid 1.00, signifying a strong correlation with the performance of the S&P 500 index. So what does all this mean? Well, in terms of performance, these ETFs are like three peas in a pod, exhibiting virtually identical characteristics. This makes them almost interchangeable for investors seeking exposure to the S&P 500. But wait, there's more. When it comes to dividends, the iShares Core S&P 500 ETF boasts a yield of 1.42%, the Vanguard S&P 500 ETF comes in at 1.43%, and the SPDR S&P 500 ETF Trust lags slightly behind at 1.37%. And what about those pesky expense ratios? Both the iShares Core S&P 500 ETF and the Vanguard S&P 500 ETF charge a minimal fee of 0.03%, while the SPDR S&P 500 ETF Trust comes in higher at 0.09%. Remember, when performance metrics are so closely matched, the fees charged by the funds become a key factor for investors to consider. Even minor differences in expense ratios can influence long-term investment returns, particularly when compounded over time. These ETFs exhibit very similar performance characteristics, making them virtually interchangeable options for investors seeking exposure to the S&P 500. Despite the similarities, there are some distinctions to be aware of. Let's delve into two key differentiators: dividend yield and expense ratio. The dividend yield is the annual dividend income per share divided by the market price per share. It represents the percentage return on the dividend. Here's how it looks for our three ETFs. IVV has a dividend yield of 1.42%, VOO comes in slightly higher at 1.43%, and SPY is at 1.37%. While these differences may seem minute, they can add up over time, especially for investors who rely on dividends for income. Now let's move on to the expense ratio. This is the annual fee that all funds charge their shareholders. It's crucial to note that this fee is deducted from your investment returns. So a lower expense ratio is usually more advantageous for you. IVV and VOO both have an expense ratio of 0.03%, while SPY has a slightly higher expense ratio at 0.09%. This means that for every $10,000 you invest, you'd pay $3 in annual fees for IVV and VOO, but $9 for SPY. When funds exhibit remarkable similarity or closely track the same benchmark, the focus shifts to assessing the fees associated with each fund. In such cases, where performance metrics like returns, volatility, and risk-adjusted measures are nearly identical, the fees charged by the funds become the most critical factor for investors to consider. Even minor differences in expense ratios can have a significant impact on long-term investment returns, especially when compounded over time. Therefore, scrutinizing the fees you pay for investing in these funds becomes paramount, as it directly affects your bottom line. So, when you're comparing ETFs that track the same index, don't just look at their past performance, consider these subtle but significant distinctions. Make a smart choice. In conclusion, when comparing IVV, VOO, and SPY, the choice may come down to individual preferences and specific investment objectives. These funds provide similar exposure to the S&P 500, with almost identical performance metrics. However, minor distinctions in fees and dividend yields may tilt the scales in favor of one ETF over another. When performance is largely the same, the focus often shifts to the expense ratio. Even a slight difference can have a significant impact on long-term returns, especially when compounded over time. Consider also brokerage availability. Some brokerages might not offer all three ETFs, or they may have different commission structures that could impact your overall returns. And let's not overlook personal investment strategies. Depending on your financial goals, you might favor one fund's approach over another's. Ultimately, investors should consider factors such as fund fees, brokerage availability, and any personal preferences or investment strategies when choosing between IVV, VOO, and SPY.